discuss about this issue. How does raising interest rates control inflation? Problem. Does raising interest rates affect the consumers? Okay. First one is loans and credits become more expensive. For example, personal loans, car loans, and mortgage come with higher monthly payments. The second one is credit card interest increases. If you carry a balance on your credit card, you'll have to pay more in interest charges. The third, let's discuss about this issue. How does raising interest rates controls inflation? Problem. Raising interest rates affects the consumers. The first one is loans and credit became more expensive. For example, personal loans, car loans, and mortgage come with Okay, the first one is monetary policy, which is handled by the central bank. This is the most common tool to fight inflation. A. Increase interest rate. This is the one of the way to fight inflation. As we discussed, higher interest rates reduce consumer borrowing and spending. This cools down demand and helps bring down the price. The second one is reduce money supply. The central bank can sell government bond to banks. This reduces the amount of money in circulation, which also slows down inflation. The second one is fiscal policy, which is handled by the government. Reduce government spending. If the government spends less, overall demand and in the economy decreases. This helps ease price pressure. The second one is increase taxes. Higher taxes reduce consumers' disposable income. With less money to spend, demand falls, which helps control inflation. The third one is supply-side policies. Long-term support for consumers. Encourage more production of goods and services. Improve infrastructure. Reduce regulations for business or provide subsidies for essential goods. This increases supplies and can help stabilize prices, especially for necessities like food and fruits.
Effect of rising interest rate on business. When a central bank like the Federal Reserve or another national bank raises interest rate, it becomes more expensive to borrow money. This affects business in several ways. First, higher cost of borrowing business. Business that rely on loan for expansion, equipment or daily operation will face higher interest payment. This can lead to reduced investment and slower growth. Reduced consumer spending. Higher interest rate mean consumer pay more on mortgage, car loan and credit card with less disposable income. Demand for goods and service drop, which can hurt sale of business. Third, stronger currency. Usually, higher interest rate often affect foreign investment, which increase the value of the national currency. This makes export more expensive, which can hurt companies that sell goods overseas. Fourth, lower business confidence. When borrowing is expensive and demand is falling, business might become more cautious. This may lead to cutting costs, include hiring freezes or layoff. Macroeconomic policy. Rising rate to fight inflation. The goal of this policy is to reduce inflation, the general rise in price, by slowing down the economy slightly. How it works. First, high inflation often comes from too much money chasing too few goods. Second, by rising rate. Third, borrowing become more expensive. Fourth, spending and investment slow down. And last, demand drop, which reduce pressure on price. In short, rising interest rate is a monetary policy tool used to first, cool down an overheating economy. Third, stabilize price. And last, preserve long-term growth. Summary for business. First, short-term pain, slower sale, higher cost, tighter credit. Long-term gain. If managed well, a more stable economy, predictable inflation, and better condition for sustainable growth.
Risk of rising interest rate. First, slower economic growth. When interest rate rise, borrowing become more expensive. This encourages business from taking loans to invest in expansion. Second, higher unemployment. With reduced consumer spending and business investment, company may cut costs by reducing their workforce. Third, increased debt burden. For individuals and companies with existing loans, increase in rates mean higher money requirement, such as like variable interest rates. 4. Stock market decline. Higher interest rate make bonds and saving account more attractive compared to accounts. 5. Risk of recession. If interest rates are rise too quickly or by too much, it can push the economy into a recession. 6. Stronger currency, weaker exports, which is attract foreign investors looking for better returns, which can strengthen the country currency. While this may sound positive, it may export more expensive for foreign buyers, potentially reducing demand for goods and hurting export-oriented industries. How does interest rate affect inflation? First, borrowing become more expensive. People and business borrow less because of loan like personal loan, house loan, mortgage, and each other cost more. This reduces the amount circulating in the economy. Spending slow down. Higher loan costs and higher return on saving discourage people to save more and spend less. Less consumer demand help ease pressure on prices. Business investment drops. Business delay or cancel expansion. 4. Overall demand in the economy decreases. Since both consumer and business are spending less, demand for goods and service falls. When interest rates decrease, borrowings become cheaper. People and business are more likely to take loans to spend or invest, which increase the money supply. Spending increases. Cheaper credit and lower saving returns encourage consumers to spend more, raising outward or raising demand. Inflation can rise. Higher demand for goods and services can lead to rising prices, especially supply can't keep up. Conclusion: higher interest rate equal all over inflation. This means like if interest rate get higher, inflation will happen. That's it.